£32,000. That's what one ordinary British family is about to hand over to HMRC on a pension that today would pass to their children completely tax-free. Not because they did anything wrong, because the rules change on the 6th of April, 2027, and almost nobody has been told. You could be sitting on an estate that qualifies for a full £1 million tax-free right now and lose a chunk of it anyway, simply because one of 4 pieces of paper isn't in place. And stay until the 4th one, because it's the asset almost no one thinks to protect. And done properly, it can shelter thousands of pounds a year with no upper limit and no 7-year clock attached to it. I'm Helen Hartley. I spent over 30 years working inside the UK pension and retirement planning world, sitting across kitchen tables from couples who assumed their affairs were in order. HMRC will never ring you to warn you that you're about to overpay. The system runs entirely on what you claim, not on what you're owed, and it only needs you to stay quiet for the bill to fall due. There are 4 assets that decide whether your family keeps everything or loses tens of thousands of pounds, and in most homes, at least one of them is sitting wrong right now. Let's go through them properly one at a time, and remember, the 4th one is the one that surprises almost everyone. Start with the pension, because this is the one changing under your feet. For years, an unused pension has been one of the cleanest ways to pass wealth to your children. A death benefit paid at a pension scheme's discretion sits outside your estate entirely. It isn't governed by your will. It doesn't touch the inheritance tax threshold. So, a pension pot built up over a working life could reach your children with nothing at all going to HMRC. Derek and Joan are a fairly typical couple. He's got a personal pension worth around £260,000, sitting completely separate from their £750,000 estate. Today, if Derek dies first, it passes to Joan tax-free. On the second death, it reaches their children outside the taxable estate altogether. Clean, legal, and hugely valuable. From the 6th of April 2027, that changes. Most unused pension funds are set to be pulled inside the estate for inheritance tax purposes. Add that £260,000 pension to a £750,000 estate, and you're suddenly over the £1 million threshold that a married couple can normally pass on tax-free. The portion above the line gets taxed at 40%. And there's a second sting behind it. If you die after 75, whoever inherits the pension already pays income tax on what they draw out at their own rate. So a child could face inheritance tax going in and income tax coming out, 2 separate bills on the same pot of money. The one piece of good news is that the exemption for spouses is expected to survive the change. So the first death barely shifts. It's the second death, the money finally reaching your children, where this actually bites. So here's the action step, and it costs you nothing. Every pension has a form called an expression of wish, naming who should receive it. Ring your provider this week and ask them to confirm who's currently named and update it if it's out of date. 20 minutes, and given what's coming in 2027, arguably the most valuable 20 minutes you'll spend this year. But what if your biggest asset isn't a pension at all? For most couples, it's the house. And this is where paperwork alone decides whether you keep £60,000 or send it to HMRC. When the first partner dies, there's usually no tax at all, because anything left to a spouse or civil partner passes completely free of inheritance tax. That part people generally expect. What almost nobody plans for properly is the second death. Every person has a nil rate band, currently £325,000, frozen until 2030, while property values keep climbing. If nothing was taxed on the first death, that unused allowance transfers to the surviving spouse, doubling it to £650,000. On top of that sits a second allowance most couples have never even heard of, the residence nil rate band, worth another £175,000 each, also transferable between spouses. Together, that lifts a couple's threshold to a full £1 million. But only if the family home passes to direct descendants, children, grandchildren, or stepchildren, not a sibling, not a favorite niece, not a close friend, however deserving. Get that wrong, and the threshold drops back down to £650,000, even though the house and the rest of the estate haven't changed at all. On an 800,000 pounds estate, that's 150,000 pounds exposed above the line, taxed at 40%, 60,000 pounds gone, purely because of how a will was worded. And there's a second trap hiding underneath it. That transferred allowance isn't automatic. Your executors have to actively claim it on a form called the IHT 402 within 2 years of the second death. HMRC will not chase you for it. Miss the window, and it's lost permanently. So this week, ask a solicitor one direct question. Does our will actually route the house to our children in a way that keeps both allowances alive? Now here's one that catches almost everyone out because it sounds like it shouldn't apply at all. Your ISA. Most people assume that because an ISA is tax-free while you're alive, it must sit outside your estate when you die. It doesn't. The tax-free wrapper protects the money while you're living. The moment you die, it's counted like any other asset. And if your estate is over the threshold, it faces the same 40% as everything else. The only reason it usually passes untouched on the first death is that same spousal exemption doing the work again, not anything special about the ISA itself. And here's the part almost no surviving spouse is ever told about. When your husband or wife dies, you inherit something called the additional permitted subscription, a one-off ISA allowance, separate from your normal 20,000 pounds a year, equal to the full value of their ISA at the date they died. So if their ISA held 70,000 pounds, you get your usual 20,000 pounds for the year, plus a separate 70,000 pounds on top, 90,000 pounds you can shelter tax-free in a single year. The deadline is 3 years from the date of death, slightly longer if the estate is still being settled. If you don't know it exists, you simply never claim it, and it's gone. If you've lost a spouse in the last few years and this is the first you're hearing of it, the phone call is simple. Ring the ISA provider and ask, my late husband or wife held an ISA with you. Am I eligible for the additional permitted subscription, and how do I claim it? Most providers have a straightforward process. Almost nobody ever asks. Somewhere in every family like this, there's a moment where the paperwork stops being theoretical. Picture a woman in her 70s, a few months after burying her husband, sitting at the kitchen table with a folder of letters she doesn't fully understand, wondering whether she's meant to be doing something right now or whether it can wait. That's the exact moment when a form goes unclaimed, a deadline quietly passes, and nobody ever tells her what she missed. This is the one I told you to stay for because it's the piece that costs nothing and needs no solicitor, and yet almost no family ever uses it properly. Every person in this country can give away 3,000 pounds a year, completely free of inheritance tax, immediately, with no 7-year clock attached. Miss last year's allowance and you can carry it forward exactly once. For a couple, that's 6,000 pounds a year leaving your estate, 60,000 pounds over a decade before any waiting period even starts. Then there's the one that genuinely surprises people. If your income from pensions, investments, or elsewhere comfortably exceeds what you actually spend, regular gifts made from that surplus can be entirely exempt, with no upper limit at all. The conditions are specific. It has to come from income, not from savings you're eating into. It has to be genuinely regular, a settled pattern, not a one-off. And it can't come at the cost of your normal standard of living. Keep a written record, because HMRC will ask for one if it's ever challenged. Done properly, this can shelter thousands of pounds a year, permanently, with no clock running down and no ceiling on the total. Beyond that, larger one-off gifts start a 7-year clock. Survive the full 7 years, and the gift falls outside your estate entirely. Between years 3 and 7, taper relief reduces the tax gradually. But the word that matters here is survive. A gift made at 70 clears comfortably by 77. A gift made at 80 after a difficult diagnosis is a very different calculation, and one HMRC will look at closely. One warning worth repeating. You cannot give something away and carry on benefiting from it. Hand the house to your children, but keep living in it rent-free, and HMRC will simply pull it straight back into your estate. For anything involving property, speak to a solicitor first. But the £3,000 annual exemption and gifting from genuine surplus income, you can start both of those this week, on your own, without paying anyone a penny. So here's where this actually leaves you. None of this requires wealth or an accountant on speed dial. A married couple in this country really can pass a full £1 million to their children without HMRC touching a penny of it. It's written directly into the law, built for ordinary families, not exceptional ones. But it takes 4 things sitting correctly at the same time. The pension nomination kept current, especially with 2027 approaching. The will actually routing the house to your children, so both allowances survive. The ISA allowance claimed by whoever's left behind. And the gifting started while there's still time for it to count. 4 things, and in most homes, at least one of them is wrong, not through carelessness, but because nobody ever sat that family down and explained it plainly while everyone involved was still well enough to act. If you know someone who's already retired or who's recently lost a spouse, send them this today. It could genuinely be money sitting there unclaimed. And subscribe so the next rule change reaches you before the deadline passes, not after it. Because the paperwork that saves your family £60,000 is always easier to sort out on an ordinary afternoon than it will ever be later, when later is the one thing none of us is actually promised. I'm Helen Hartley.